What's up everybody, Jaspreet Singh here, and let me read you the #1 top article from Yahoo Finance's homepage yesterday. The title is, "Businesses are, quote, feeling the economy weakening despite the strong economic data." We've been hearing from the Fed and the government about how strong the labor market and how strong the economy is, which is why we're not in a recession despite us seeing a, quote, technical recession, which is 6 months or 2 quarters of an economic decline. They keep saying how economy is strong, how people are strong, and so we're not seeing a slowdown in the economy. But now we're starting to see an uptick in unemployment slowly. Like yesterday morning, we saw the newest jobless claim report, and it came in at 260,000 new jobless claims over the week, which is the highest jobless claim number that we've seen since November of last year. And if you look at the jobless claims reports over the last month and a half, what we've been seeing is that week over week, every week, we've been seeing jobless claims slowly start to rise. Now, if we zoom out a little bit and start to get a general temperature of how companies are feeling about the economy and everything going on, you're starting to see that companies are really now starting to tighten their belts a little bit. They're getting a little bit more picky with how they spend, because it's becoming more and more important for companies to really be profitable and make cost-effective decisions. Like Google, the CEO of Google came out, and there was an article published about this. The title is, "The Google Chief Warned Bloated Staff of, quote, real concerns over productivity." And essentially what he did was he had a meeting with this company, and he said that we need to ASAP figure out how we can be more productive, aka generate more dollars per employee as soon as possible, because if we don't, we're gonna have to start cutting your jobs. So if you can't find a way to be more productive, your job is gonna be gone. Now, Google Alphabet is a very strong, very established, very profitable company. And so, over the last couple of months, we've been seeing layoffs in the more speculative companies, the companies that have not been profitable, the companies that have been relying on outside capital, the companies that have been really bloated, that are now laying off to become more lean. And so now when you're starting to see it happen in the tech companies that are more established, well, that's a little bit more concerning, because now, they have been around a long time and they are stable and they are healthy, but now you can see that they're starting to feel the pinch, because like Google is supported by advertising revenue, meaning companies who want more marketing and exposure, they pay money to Google for exposure, and now they're starting to see a decline. So Google needs its employees to be more productive in order for them to continue maintaining the jobs. Along with that, there was a new job openings report, and this came out, Reuters covered this in the early part of August 2nd it came out, and it says that job openings in the United States have fallen to a new 9-month low because the labor market is holding tight. So what does that mean? We're starting to see unemployment numbers go up. Companies are saying employees need to be more productive, and job openings are starting to drop, or they're dropping, meaning companies are hiring less. So companies are looking for less new employees, and the companies that have employees need their employees to be more productive, and the companies that are bloated are also laying off their employees. So kind of a different shift for the job market, because up until, now still, everybody keeps saying about how strong the economy is. And yeah, we are seeing some good signs in the economy. Like we've seen companies like Walmart now liquidating some of their products, meaning they're cutting the prices of their products because people haven't been able to buy them, which will help ease inflation. We're seeing gas prices come down, which will help ease inflation. But the inflation fight is not over, and the economic slowdown is not over. What's happening is a lot of people are now thinking that because inflation is going to be coming down, because now we're seeing Walmart and other retailers do liquidation sales or cutting the prices of their products, because we're seeing gas prices come down, because we're seeing real estate prices come down, inflation is going to be lower. That means that the Fed won't have to keep raising interest rates, which means that the Fed might start stimulating the economy, which means that the Fed might start stimulating the markets, And so traders and some investors are preeminently investing their money based off of that because they think that the Fed is going to start entering a stimulative economic environment sometime either later in 2022 or early 2023. Now, while that might be the case, you really got to pay attention to what's going on in the economy because, just like kind of what happened with inflation, what we don't want to see happen is everybody thinking inflation is transitory and then 12 months later find out, oh, this inflation wasn't transitory. Well, over the last couple months, we kept hearing about how we're not in a recession, it's not a real recession. And then 12 months from now, we don't want then people to be surprised and say, oh, we are in a deep recession. So this is where you want to be aware of what's going on and kind of just understand that unemployment probably will get higher. We're going to see the job market change. We're going to see unemployment go higher. And AMD actually talked about this. AMD is the semiconductor company that produce chips that are used in computers and a whole bunch of other technology parts. And they kind of issued a warning where they've been seeing a huge decrease in sales for PCs and other technology products. And they're saying that because of that, their business and their industry is hurting. And they're saying that one of the reasons that people aren't buying as much PCs and other things like that is because, well, either people bought a whole bunch during the pandemic, and second, because people just don't have the money to keep going out and buying more of these discretionary items because you don't need a PC to survive. And because people are buying less of these items, well, that's kind of an indicator of a slowdown in the economy and that they're going to see a slowdown on their side. Now, we are covering all this in Market Briefs, which is why, again, if you have not subscribed and joined Market Briefs yet, make sure you do that. It is a completely free financial newsletter that I created where every day my team is breaking down what's happening in the stock market, the real estate market, the crypto market, inflation, and the global economy. So if you are an investor or you want to be an investor and you want to stay informed on what's happening in the financial markets, this is the easiest way for you to do that, and it's completely free. My team is breaking it all down for you. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. Now, this brings me now to the question of what do you do? Because there's a lot of interesting things happen. Yesterday, I talked about how you have countries like China and Russia working to create a new reserve currency. Now we're starting to see the economy start to slow down. We're starting to see unemployment start to tick up. What do you do? Do you change your strategy? The question is, okay, what should I be doing? The answer is no, don't change your strategy. Keep investing your money. And this is where, it's about having a strategy that's been time tested. So if you're focusing on the stock market, what does that mean? That means now there's two different ways that you can invest. And I'm talking about investing, not trading, because I don't understand trading. I am not a good trader. I speak only of investing. Investing is when you hold on to a strong investment for the long term. Well, chances are over the next 12, 18 months, we're going to see a lot of volatility where we're going to see shocks in the economy, in the market. And this creates opportunity now for you to come in and purchase some of these investments at a discounted price. However, that requires you to do two things. It requires you to be prepared and it requires you to be financially educated. Prepared meaning have cash, that way you can now go out and actually purchase some of these investments. And financially educated meaning knowing what to buy. So being prepared is something that you have to do now. When times are okay, you're working to earn more and spend less so you have more cash to invest. Second, on the financially educated side, this is something that you can do now is make a list of companies or ETFs or whatever it is that you want to invest in. Do that research now. Find the good investments, and now you're just waiting for a good buying price. If we start to see more layoffs, if we start to see the economy come down more, if the market gets shocked by what's happening in the economy, well, you'll probably see markets go down. And that could create an opportunity for you. Now, of course, you don't want to just bank on this because the Fed could start stimulating and that would cause markets to rally. So this is where, there's a couple of different ways that you can play it. The passive strategy is now every week, you just keep buying more ETFs or companies. I do ETFs where you have a few ETFs that you want to invest in. And every week, whether the market's up or down, you just keep buying no matter what happens. The second strategy, which is the active strategy, is now you're going to look for investments, whether it's ETFs or stocks, and now you're monitoring them and you're just waiting for a good buying point. meaning you're waiting for a good price. So if you see something bad happen in the economy and this push markets lower, that can create an opportunity for you to come in and buy. Now again, the active strategy takes more time. That's why it's called active. It takes more financial education. It takes more research. If you want to do that, that's fine. Just understand that the passive strategy is something that does not change with the markets, and you just keep doing this. But you want to be aware of what's happening as an investor. That way you can be on top of what's happening instead of being one of the people that's shocked and surprised by what happens. And many of the things that are happening, this is not the first time we've seen all of this happen. So this is where, understanding history, understanding what's happening now, all this is important. That way you can be an educated investor, because while history doesn't repeat itself, it does rhyme. And we're keeping you updated on market briefs, which is why if you haven't joined yet, make sure you do that.
Cause the price of all assets to drop. Now, assets are things that people buy for the sole purpose of making money. And now when these asset prices drop, it's like Black Friday for investors. Now you can come in, find some of these investments at a discounted price, and then ride up the wave, but it requires the patience and it requires the right financial education.